Hello and welcome to Alpha Action, everybody. It's Ramil, your host, and today we got a long-short trade idea on PG&E and Xcel Energy. And so, just to preface this before we start, the reason we're doing a lot of long-short trade ideas right now is because this is a stock pickers market right now. It's a bottom-up market that we have right now, and we've had this for about the past year. We probably will for quite a few months in the future, where you have companies within the same sector moving completely different directions. And so this is a perfect, ideal environment for a long-short equity portfolio. Okay, so PG&E on the short side. They have an EPS of -20, and taking that with all the float for the whole market capitalization, earnings of $10.5 billion in earnings. And then cash and cash equivalents is 1.6 to 1.7 billion. And so this leaves about 2 months till the company runs out of cash. And so the first thing, if PG&E is losing money, is that the cash and cash equivalents, that's the first thing that comes up. After that, they start going into debt, they need to finance. And then after that, they probably need some restructuring or they're going to go bankrupt. And so we can talk about all that right now. Next question that comes up is that they could just finance, and that after they run out of the cash and cash equivalents, they can just start financing. And so here's the problem faced. The problem faced is that the company tries short-term financing, is that it kicks the can down the road, and it's going to have to pay back that debt, which will worsen the problem. Another option is that the company can release convertibles and pay them back with equity. And this is going to force the company to just give away equity to its creditors, and that's going to make the situation worse. What else they could do? They could sell some shares. Again, that just lowers the price even more of the underlying, and so that also makes it worse on them. And then the most obvious one right here is, can they start selling their assets? Because right now PG&E is trading for just 0.62 times the book value, and so it's trading below intrinsic value. But with that said, it's got quite a lot of problems right here. So the next question that comes up is, can PG&E just sell its assets? It's trading at 0.62 times book value. And so it is hypothetically able to just sell many assets because trading so low versus the intrinsic value, and it has quite a lot of assets. Now that's true, but with that said, it's similar to the above option. It's just going to kick the can down the road because eventually you're going to run out of assets to sell. And then also, many of these assets are going to produce a cash flow or a revenue stream for the company. And once you sell those assets, then the free cash flow is just cut, and that worsens the situation. And so all of these options that you went against, first you have the cash pile. Once that cash pile runs out, you start selling assets. Once that runs out, you start financing. But then you're in a lot of debt. You can't produce free cash flow. So what do you have to do? You have to start restructuring, and that's quite costly for the company, or they have to go bankrupt altogether. And so as we were discussing right there, what's PG&E's fate? PG&E is doomed for bankruptcy, a buyout, or restructuring. If a buyout happens, then it'll be lower. Then it'll be at a lower market capitalization. Okay, so on the other side, the long position. Why Xcel Energy has a long position? Well, first off, net income from continuing operations is growing at a rate of 9% annually. If this current trend continues, and I see no reason that it shouldn't, and it's trading at 25 times earnings. And so when you first look at this, you see a PE of 25. You might think that's quite overvalued. And in fact, if you go online, it does say that's overvalued. But with that said, growth of 9% annually makes up for that because price to earnings to growth relative to risk. And so it's price to earnings, and then how much will those earnings grow and how much risk do you have on those earnings. And so that brings in equity risk premiums, and then it also brings in the rate of growth. And we're going to talk about both of those. So the company has plans to pay off its manageable debt right there. And so that right there reduces the risk. And if this company were bought right now, 7 years into the future, it would have a price to net income of 10x. And so that's the growth right there. But is this growth safe? Is it sustainable? Is it risk-free? Well, as we said, very little debt. They're going to pay it off. And then operating cash flow isn't at risk because first off, energy, and when we say energy, we're talking consumer staples right here, or utilities otherwise. And since it's a consumer staple, it's defensive, has a healthy balance sheet, margins are wide, so if there's a price wars, margins are wide, and there's a growing cash pile to supply any negative net income, which I don't expect, but they still have a large cash pile. And so it's price to earnings, and those earnings are how risky are those earnings and how much growth will the earnings have? That's the main question you have to ask yourself when you look at a PE ratio, because E just tells you earnings. It doesn't tell you how risky the earnings are and how much growth the earnings are going to have. And you need to take those in yourself. Right here, though, it has quite a lot of growth, and very little equity risk premium should be added onto this because it just doesn't have the normal risk that you would find in a normal equity risk premium. Usually equity risk premiums are 5 times, so you have the risk-free rate at 2%, and at 10% you might have the return, and so it's a 5x equity risk premium. Right here, though, in this sort of environment, especially with utilities, strong balance sheet, large cap, wide margins, growing cash pile, manageable to zero debt, you simply don't see that sort of equity risk premium. And so actually this is quite risk free, and the growth is quite sustainable. And so what's the trade right here? We're going to be short PCG, as you already gave the reasons for that. Then we're going to be short the January 2022 3.5 put. We're going to be long XCL, short the January 65 calls, and roll over the trade until you're not fundamentally convicted anymore. So first, let's start with the short January 2022 3.5 put. Why do we want to do this? Well, whenever you short a company and you expect it to go bankrupt, it's going to be very hard to cover that. And so you want it really a guaranteed cover. This right here is basically a limit order saying that we're willing to sell at 3.5, or we're willing to cover at 3.5, and they're paying us to do that. And so first off, this raises your statistical probabilities of making money. And secondly, we're able to sell at 3.5, so we don't have to wait till it gets all the way down to 0, and then might get delisted, and so it's going to become harder to cover that position right there. And then another thing right here also is that if this company goes bankrupt, the options will be delisted, the stock will be delisted, and so all the extrinsic value that's packed into that option will go down the drain. And so we can take advantage of that right there. And the long XCL, this is not so much a bet on XCL than there's a bet on PCG, because all we're betting right here really is a downturn PCG, and we're using XCL mainly as a proxy to hedge against the PCG bet. And so long XCL, short the January 65 calls, and so XCL is really more of a hedge for us rather than a directional bet that's going to go higher. And so we want our hedge to at least produce cash flow and pay us. And so we can short the January 65 calls and then consistently just short calls out of the money on this. And so that's going to produce some cash flow for you on your hedge, because really this hedge, although we do believe it's going to do good relative to the rest of the utilities, relative to the rest of the market, it's going to make a positive return, and especially relative to PCG. But with that said, really we're in this trade for PCG. We're just using XCL as a hedge, but we want the hedge to pay us, and so we can short the January 65 calls, and that also raises the probability of success right there. And again, as I said, roll this over consistently until you are not fundamentally convicted of this trade anymore. Thanks for watching, guys. We have videos like this every single day. Every single day we come out with trade idea videos, and so just stay tuned for this. Please subscribe. Until then, happy trading.